an economic update, Brian. It's a big week for you. You've got some momentum happening with mortgage rates. Talk about that. Let's start with where the rates are going. We got a 10-year Treasury that's now hit a low marker for the year, and we've got some mortgage rate momentum. What's going on there?
Sure. So, as we mentioned before on the show, there's a pretty strong correlation between the 10-year Treasury U.S. bond and the 30-year mortgage rate. Those two are actually more connected than, when you hear on the news that the Federal Reserve cut the federal funds rate. That's kind of more of a short-term rate. But the 10-year Treasury is a long-term investment. It's kind of similar to the mortgage rates. So that's why we watch it. And it dipped below 4% for the first time since April of 2025. So
we had one hour in September.
1 hour? Okay.
It was 3,999 on September 11th. That was, a couple days before the last Fed meeting. And so it just touched 399, but this is
okay.
Obviously the lowest. By a couple of, slivers, this is lower than that marker, so it is the year-to-date low since April. But we've only had, so when you look at yesterday, you look at that one moment in September before Jerome Powell screwed it all up, and then you look at April, you've had 3 moments in time that lasted hours each time it hit. Now who knows what happens here going into Monday? Maybe we have momentum that continues where the 10-year stays under 4. But we've had 3 moments of time where the 10 years hit under 4% all year to date, this being one of them. And they vanish as quickly as they come. When they're here, you get a 30-year fixed mortgage rate, which you follow closely, that falls with it typically. And you can lose that momentum. Right now, leading up to the next Fed meeting here in less than 2 weeks, we're in the same, it's deja vu as of what we had beginning of September, leading into the last Fed meeting. We have momentum. They're pricing in this cut that's all but guaranteed to be coming. Powell this week talked about they're going to stop quantitative tightening, QT. That should signal more cuts coming. And you've got this momentum that's happening. And so my expectation is that not only, what we saw at the end of last week, that we should see it continue next week, meaning 30-year fixed rate mortgages continue to move down. That's just an expectation. Obviously, nobody can predict this stuff, but that's what happened before the Fed meeting last time. That's probably what's going to happen here over the next week. And then we'll see if Jerome Powell decides to lean into that momentum by having a clear plan when he speaks to the press after the meeting in about a week and a half, or if he completely just screws it up and is uncertain and waffles and showcases that he's typically way behind the 8 ball. And then if that's the case, investors will get nervous and we'll lose all that momentum and rates will go back up.
Yeah, so I totally agree about what you said about being short-lived. In fact, about the head of our rate lock department sent out an email yesterday afternoon letting us know that it had dropped below 4%. And she mentioned, the last few times that we've seen this, it really was short-lived. So if she was kind of saying if anybody's got a rate to lock, you might want to consider locking it now. Of course, nobody knows for sure what the future holds, but we've kind of, bounced along the bottom, as they say, or there's this kind of imaginary line of resistance, which is, mortgage rates under 6%. According to Mortgage News Daily, the average 30-year has not been below 6% since August of 2022. So, we're over 3 years now, over 6%. The 12-month low at one point in September, according to Mortgage News Daily, it got down to 6.13. Last week, at the end of the week, we were at 6.38. This week, according to Mortgage News Daily, average 30-year on Friday hit 6.23. So it did drop despite, the government being shut down, there being not a lot of data. We could talk a little bit about why that might be, but it's kind of approaching that line of resistance where it tends to bounce off the bottom and then kind of go back up again. So who knows? Maybe events will transpire that will finally break through that 6% resistance, but that hasn't happened in the last 3 years. So I wouldn't bet hard on it, but anything can happen. It's going to happen someday.
Yeah, I had Barry Habib on a industry podcast last week. Barry Habib is actually a Fannie Mae board of director now, but he's been in the mortgage industry for decades. And
yeah, he's been around a long time. I heard him talk in like 2009.
Yeah. And so
what did he say?
He has this established career, obviously, which has now put him into on the Fannie Mae board of directors. And he wasn't speaking for Fannie Mae and their projections. Their Fannie Mae official projections do have the 30-year fix ending next year, 26, under 6%. His projections his personal viewpoint took it a step further. And he sees a world next year where we're like in the mid fives on the 30-year fix. And, obviously his role right now in the industry, he's, he can make some of those projections. Obviously, somebody like Brian here, who is actively helping customers every single day get their financing needs solved over at scheduleloanappointment.com. He's not allowed to make those projections. But, just generally speaking, where he's at, you can see a world where the spread between the 10-year and the 30-year fixed mortgage rate continues to improve. And you don't really need, if the spread improves, you don't really need the 10-year to keep dropping to see a world where we could get close to 5.5%. You can also, see a world where we have more volatility like we've had the last 3 years, and we kind of get close to 6 and bumps back up to 6.5 or high sixes for periods of time. What we've seen the last couple of years, a lot of those are driven by, concerns on inflation. And so, how the Fed is going to discuss inflation and what's going on there in a week and a half is obviously going to have some kind of impact here for the fourth quarter.